Many of you asked me to do an update on Target stock, ticker symbol TGT. It has been an absolute disaster. It has topped out pretty much around $270 per share, and now it's sitting at $105 per share. I mean, it's pretty disaster. I did a video on the stock 3 months ago. It was sitting around 125, and I said I would not even touch or even look at Target before it hits at least $100 per share. And now we're getting pretty close to that, sitting at 105. So I decided to do a pretty quick update on my own valuation model on Target. I'm gonna give you my updated, price alert. I'm gonna tell you exactly what I'm trying to do with Target and just my thesis in general, and just tell you what changed, and just talk about the stock in general. So I really hope you enjoy it. Now, in terms of the latest earnings report, I mean, it wasn't bad at all. They actually beat on EPS and the stock rallied. They put up $1.80 versus $1.39, massive beat. But they did miss on revenue with $24.7 billion versus $25.16 billion, which was actually expected. But they did do pretty well on EPS. But the main thing that made the stock so weak, and it pretty much killed the stock, was the guidance. Because the guidance on comparable sales, they now expect it to decline about mid-single digits, and EPS between $7 to $8. Now, their previous expectation was around the slow single-digit growth, and they expected EPS $7.75 to $8.75. So this is over pretty much a pretty big downgrade, in my opinion, for comparable sales and EPS. But it's not the only one. A lot of other retailers are facing the same problems. Although you have retailers even like Ulta Beauty, which is a makeup store, they're still increasing their EPS guidance, which is pretty astonishing. I talked about the stock, but this is the story with Target. It's very, very bad. And one of the reasons why Target has been massively underperforming other retailers like Walmart and Costco and many other, it was pretty much one of the COVID bubble beneficiaries. I mean, everyone got the stimulus checks. They went to Target, bought new TVs, bought, kitchen, equipments and cooking stuff and all that kind of stuff. Groceries are only 20% of Target's annual revenue compared to more than 50% of Walmart's annual revenue. So it's only 20% for groceries for something like Target, and the rest, pretty much 80%, a lot of it is discretionary items. I don't know, makeup stuff, something for the kitchen, decoration, I don't know, carpets or something crazy, or TVs or computers or laptops and gadgets and all kind of things that you just want but you don't really need. And this is why Target has been suffering. This is why the comparable sales, they look absolutely horrible. I mean, just look at this chart. I mean, I can't look at this chart enough. It's pretty astonishing. Estee Lauder's chart, looks the same. A lot of the COVID beneficiary stocks, they pretty much look the same. It's pretty disaster. You can see it in terms of the net income margins. The net income margins, I mean, they were around 4% on average. They went to 6.5% in 2022. The massive expansion. Wall Street got excited as usual at the wrong time. And then in 2023 so far, the net income margin is only 2.5%. I mean, much lower than the 4% historical average. This graph would show you what's happening at Target. They are trying to cut costs, fire some people, do stuff, but they also face a lot of theft. A lot of retailers are facing theft problem and losing inventories and stuff. So it's been ugly for most retailers. And if you look at the balance sheet of Target, they actually made some kind of an improvement on inventories. They were around $15.3 billion in July of 2022. Then in January, around $13.5 billion. Now it's $12.6 billion. So it's improving on inventories. They're still a little bit higher than the historical average, but it's improving so far. This is very encouraging in terms of Target. They do have around $1.6 billion of cash. For long-term debt, they have around $50 billion. I mean, still producing positive free cash flow. This is a pretty good company. I mean, I don't think the debt is a big problem in this case, but I'm very worried about the deteriorating macro environment with groceries only making 20% of Target's revenue. But this is why the stock is not sitting at all-time highs. The market normally prices such things in beforehand whenever the sentiment gets bad. This is why you have a lot of stocks that are already on bad earnings, because the market already priced it in, and just the stock has been a disaster. It declined so much that even bad earnings are somewhat bullish for the company. We have seen it play out many times before. And if you look at the PE ratio of Target, this is why I stayed away from it in my last video. When I made my video, Target was sitting around 15 times earnings, which is the historical average. This is why I said I'm not even touching Target. It's barely back to the mean multiple. It doesn't even make sense to me. Well, now Target is sitting around 12 times forward earnings, forward PE ratio. This is, I mean, lower than the historical average. The lowest it ever traded at was around something like 9.5 times earnings, and this was in the 2008 to 2009 financial crisis. Now sitting at 12 times. I mean, this looks much better on the surface, but I still have to go into my own valuation model to determine a fair price on target. Now, this is what I have on target. I have 0% revenue growth in 2023, which I believe is fair. And later on, I have something pretty small, which is a 3% increase. Normally, target used to grow 5 to 7%. I'm expecting something more conservative, so around a 3% revenue growth. After they revised their guidance lower, this is why I had to update it, which I believe is still fair. Net income margin, we talked about this. The historical average was 4%, so I kept it at 4%. We talked about the PE ratio. The mean PE ratio was 15 times, so I'm assuming target's gonna go from 12 times back to the mean multiple once, you know, things clear up, once the economy looks a little bit better, 4 to 5 years from now. So around 15 times earnings and a 4% dividend, which is the current dividend on target, I'm getting something like a 70% on the upside, or 11.2% CAGR for the next 4 to 5 years, which is actually not bad at all. But if I want to double my money on target with this very conservative estimate, I think it's conservative because target can grow revenues maybe 5 to 6% instead of 3%. Target maybe could trade at 17 times earnings instead of 15 times. But I'm just using the base case scenario. If I want to double my money, I would have to buy target around $90 per share, which is a little bit lower than my previous video of $100 per share. The main reason it's lower is because I used slower growth numbers after they revised comparable sales and after they revised the EPS. This is why I used lower numbers, and it would be something around $90 per share. $90 per share on the stock is pretty much what it was in March 2020. I'm not sure if Target is going there, but we have a lot of stocks that are sitting even below the March 2020 lows, so it's possible. I think Target is looking better at this price, I have to admit, but if you're a very conservative investor, like myself, I would personally not touch Target before it hits, somewhere close to $90 per share. So entire market's going down pretty much, except the Magnificent Seven. I personally see much better opportunities in the market than something like Target. So this was my honest opinion on the stock. Thank you for watching the video. It was not financial advice. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.